I hope you can all hear me. I've never actually been applauded before I've said anything. I'm not wearing my jacket because I'm not actually an IFA and I'm not from Meyado, so I'm about to do these things. And if you don't mind, I'm going to wander around a bit as I speak. It's the only thing that stops me from falling over. I see we're in a cinema, so we thought it suitable that we'd actually show a movie at some point during the evening just to wake you up, an action movie on the CDO crisis. So what I'm going to do is I have the delight of taking you, the problem with all these things is, of course, at the end of it you get some food and you get some drink. And trust me, after I've spoken, you're going to need a drink. For those of you who don't drink alcohol, tonight's the night you're going to be converted. So what I'm going to do is talk about what I typically brief the Chamber on. I also do some private briefings for the British government, who seem to have an interest in regional economics here and the DTI. The title of the thing is Money, Oil and Politics. So I usually talk about the three most important things in life, the global economy and money, energy and oil. Sadly, it remains very, very important. And then finally politics. So that's the sort of topic range. What we're going to do is I'll speak, Mark's going to stand up and talk about, so what do we do next and how do you actually manage investments? Because we are economic strategists, we're not tacticians who are going to tell you what you actually buy and what you actually sell. And I think we're going to take questions at the end. So if that's good with everybody, let me just sort of start. I'm going to start, before I get on to the economy, and that's where I'm going to spend most of the time, I thought I'd just start by hinting at some of the political issues that everybody is thinking about. As we all know, Hillary actually won Pennsylvania, right? Despite everyone thinking it's going to be this guy. And we now have what looks like a face-off between these two, because the superdelegates still have to make a decision who's going to be the Democratic candidate. There is, of course, McCain and the Republican card still out there for the most important elections in the world in terms of affecting all of us in our future, but we still believe that the Republicans and McCain will most probably not make it to being the president of the US. He's not sufficiently on the sort of far Republican right for the hardcore evangelical sort of Midwest of America Republican stronghold to really like the guy, and that's the problem. And there is such a sort of deep-seated anti-Republican as well as Democratic thinking that it's time for a Democrat. It's likely to be one of these two. All I'm going to say on the choice of the two candidates, in our view, is just to give you a little story about Hillary. And that is the two of them, Hillary and Bill Clinton, the perfect couple, driving around in a car, somewhere in Alabama or wherever, and they drive past a gas station. Hillary looks out of the window. She happens to catch sight of a very ordinary-looking, regular Joe with a baseball cap pumping gas, and she goes, "Oh my God, I know that guy. That's Jimmy." Right? And she turns around to Bill and she says, "That's Jimmy. Do you know, that is my high school sweetheart. That is the bloke that took me to my high school prom." Right? And Bill sort of looks his nose down at Jimmy pumping gas and he says, "Well, I'm sure you are really glad you ended up marrying the man who was going to become the President of the United States of America." And she looked at Bill, she looked at Jimmy and said, "Bill, if I'd married Jimmy, he would have been the President of the United States." Do not underestimate the ambition of Hillary Clinton. So it will be an interesting race, both the nomination process and the end presidential election. The only question for us from the point of view of global strategy is, will it make any difference to American geopolitical stance and foreign policy on the situation in Iraq, on the standoff with Iran, on the whole thing with the sort of Muslim fundamentalist sort of pressure that America's been providing, Patriot Act, all that kind of thing. We don't think it will make that much difference. The problem is America now has gone too far down this road. They're too boxed into the problems in Iraq to very easily withdraw. Maybe there'll be an easing of tensions with North Korea and Iran, which are the other two, as you know, hot issues. But we're not looking for major significant changes to the current geopolitical standoff between the US and the Muslim world, sadly. So let's get on to the world economy. We'll come back at the end to just a quick summary of our views on geopolitical risks, where we stand, what we think's got worse, what we think's got better, what you should be worrying about. Economy, as you know, things have not been looking good. You've all heard the word about, you know, the CDO crisis, even though most people don't understand exactly what it is, leading to a housing meltdown, leading to a financial meltdown, leading to potentially the US economy in recession. The major questions we get, and the ones I'm going to try and answer tonight, are four key things. You know, is there a recession, which we think is pretty clear there is, but more importantly, is this going to be a long, you know, recession that drags on for a long time, is very, very serious and mimics, you know, the Great Depression of the 1930s, as the extreme pessimists are going to say. That's a pessimist camp. Or is this going to be a so-called V-shaped recovery? And don't forget that the average length of time of a US recession since the war has only been 10.5 months. Pretty short. So people, quite rightly, you know, talk a lot about the strength and resilience of the US economy, how vibrant it is, its ability to always bounce back from troubled times, and the competitive dynamics in the economy that always mean that even when it has bad times, it's pretty short-lived. So that's question number one. Question number two we hear about is there appears to be an inflation problem in the world. Should you guys be worrying about it? And does that influence your investment strategy? And this great word that economists came up with back in the 70s of stagflation, which is this odd mix of how can you have low growth and at the same time rising inflation, because usually those go together on the way down. You know, is that an issue? Is there stagflation? Should you be worrying about it? And the third thing we're going to be talking about is the other great economist word, decoupling. Everyone says, okay, so America may be going down, the Western economies may be having trouble, but here in Asia we're okay. We decouple, we have the strength of China and India, we are the new world for the 21st century, and we can keep growing irrespective of what's happening with the US. And the last thing, the fourth thing, is of course the great question of oil and oil price and the whole commodities supercycle boom. Is Jim Rogers right, or is this actually another bubble? And, you know, at some point in time, we're going to see wheat and tin and copper all coming down. So that's the ground I'm basically going to cover. Quick summary on where we are at the moment. The good news is finally the US administration, the Fed, even the White House are admitting that there is a problem. It took a while, which is why I love this cartoon. But we think that the latest data, and the US government is now saying, well, officially, you know, there is problems. We are in recession. The US economy is in trouble, and it's going to be a while to get out. And they're starting to, as you know, both monetary policy and fiscal policy, both monetary easing and fiscal giveaways to taxpayers to try and reflate the economy again, which is the old American, funnily enough, very Keynesian way, being a sort of good socialist when trouble strikes and then reverting to capitalism in the good times. That's how they're trying to deal with the problem. If you look at the market reaction and market performance, for those of you who are dumb enough to still be holding equities, remember we have warned many of you who follow us several times during the year last year to get rid of your major portfolios in the Western markets, but if you haven't, you can see performance year to date has not been good. What's interesting is that after an absolutely miserable last 6 months in equities and a very miserable first couple of months, the numbers at the bottom are the last time we did an economic briefing in March. Those were the performances of the major markets, and the red bars are the current performance for April. So as you can see, most of these markets have recovered, right? Dropping the CAC dropping down 20%, but now 15% loss. If you look at STI for Singapore, for example, it went as deep as 18% loss, but now it's clawed a lot of that back, nearly 8% for the year. Okay? And everyone is starting to think, whoa, you know, things are stabilized, the Fed has this all under control, we're out of the woods, time to start buying again. Right? That is what we call in the trade, it used to be a trader a long time ago, the dead cat bounce. Right? I've never understood quite why they use a cat rather than a dog. Maybe it's because traders, you know, quite like dogs. And when things get really bad, you chuck cats out of the window. But we do not believe that this is anything other than a short-term bounce, mainly because there's no major new economic data coming out. And the long-run stats coming out in terms of the housing numbers, the effect of housing on the crisis, the foreclosure rate, what's happening with the banks, full revelation by all of the banks on what else is there other than CDO losses that they've already written down. We think a lot of that is still to come. So we do not think that equities are out of the woods, and we think there are still some further bounces like this where it goes up a bit and then goes down a bit more and then goes up a bit and goes down a bit.